and we will talk about inventories tonight. So to give you a roadmap of what we are going to discuss, my main focus is going to be on the first half in terms of assigning costs to ending inventory and weighted average FIFO and LIFO. The second objectives are focusing on using gross profit and retail and distribution of space to identify inventory and how frequently it turns over. So your quiz is mainly focused on this part. Your homework, for the most part, is focused on that part too. This second half part, you may have a couple questions on the homework assignment related to it, but there are none on the quiz. So types of inventory systems. The more modern approach to inventory systems is the perpetual inventory system. So thinking about like POS systems and stuff like that, that are able to, in real time, remove and deduct things that are sold or taken away from inventory. So that way you have a better accounting of your rate of sales, the frequency in which you need to replenish your inventory, and things like that. That's kind of the modern approach. However, a lot of larger organizations operate under the periodic inventory system. So if you've ever worked in a grocery store, inventory is like the worst day of the year because you basically have to rip everything down and count everything. I was recently in a Walmart a couple weeks ago where they had the inventory documents out, so I knew they were doing a periodic inventory. Although it seems like some grocery stores and a lot of stores are starting to move more towards the perpetual, especially with like online orders and like pickups and curbside type and delivery options. It's becoming more critical to have that real-time analysis of how much you have in stock, so you don't have people that are using like grocery services to be disappointed when they say that it's in stock. They theoretically pay for it in advance, and then they have to substitute it with something else. So periodic is kind of going away, but it's still pretty relevant because a lot of businesses either are really bad at taking inventory, or they don't want to, or they don't have the upgraded technology and systems, and so they still use the periodic system. So the first thing that when we're taking inventory we need to utilize is the specific identification method. And so what we want to do is, in terms of determining inventory, is we want to take into account what we had when we started. Usually it's a year when you're analyzing inventories, what you have at the start of the year and what you have at the end of the year. That's important, one, to account for how much you're selling, so you know how much you need to buy every quarter, every month, every week when you're trying to make sure that you have enough in stock. The second reason is so you can estimate the cost of your goods that you sold. So knowing how much the cost of what you sold is helpful because it helps determine your gross profit margin and helps you determine whether you're making money or not. One of the most critical things when you're running a business that is based on frequency or volume of sales, which is most businesses, is inventory. And as we're going to learn tonight, there's different ways of accounting for inventory. But from a value perspective, I've always approached inventory just being equivalent to the cost. So the reason why we have different methodologies is because different units cost different amounts at different times when you purchase them. And so we have different ways to kind of reconcile that. Because if you presumably sell them all at the same price, then it's really just a matter of determining your gross profits based on what you still have in inventory and how much it costs you. So that's why it's important to assess what's known as the cost of goods sold. So this inventory table is going to be used for the next few slides. It's a hypothetical case study of a hypothetical company called Blue Company. And so what this table is identifying in the left-hand column is the amount, the date, and the type of purchase that's being made for the inventory of the good or service in which you are trying to sell at retail. This may vary based on production process. So if these are raw materials, then you're going to have value added that comes from the gross profit, which is, from my economics background, the way I've always looked at it, because of it being contributed to GDP and the value of production, especially if it's not sold, it's that equivalent to the value of the cost. But as a business, the left-hand column is saying when you make your periodic purchases. So maybe you buy every 3 months, every month, every 2 months, intermittently, that's without consistency. Regardless, the dates and the number of units that you purchased of a item are listed in this graph, or this table. So the second column tells you how many units you bought every time you purchased it. The third column is telling you how much it cost you per unit in that batch that you purchased. So notice that the cost per unit changes every time you made a purchase. So outside of the beginning inventory, you made a consistent 20 unit purchase every buying period, but the cost per unit rose throughout the year. And that's where we get our variation in terms of our inventory calculations. If we do last in, first out, or weighted average, you're going to get different assessments of the cost of the inventory, and by extension, the cost of the goods sold. So the takeaways from this is you always need to know how much your ending inventory is as well, because in order for you to calculate cost of goods sold and things like that, you need to know how much is in there at the end of the year versus at the beginning of the year. So if we add up all of the number of units that were purchased, aka including the beginning of the year inventory, we have 120 units that were available to be sold of this good or service at Blue Company. The total cost, though, varies from purchase to purchase, but the total cost for the year is $1,200. So that means that the total cost to the firm, to the business, is $1,200. That's your identification. You have 48 units at the end of the year, which is going to be important because you sold 72. So those 72 units, we don't have to worry about. We sold them. We got our revenue from it. But the other 48 are costs. In a way, they're still an asset because you can sell them for money, but maybe they're not going to sell for retail anymore. Maybe they're going to sell liquidated if you're trying to make space for new inventory. So that's why it's important to understand this, because at certain points you don't want to, if you have finite space, you want to get rid of that space. And sometimes you have to figure, okay, instead of just holding on to it and letting it depreciate or sell for less because the market demand is low, sometimes it's in your best interest to liquidate. So if we happen to know which units haven't been sold yet, so in which you probably aren't going to, if it's something that presumably has an expiration date, you're probably going to use the first in, first out method. But if you just so happen to know that the ones that you sold happen to be the ones that were sold at the beginning, or that you had at the beginning of the year, and some that you had in July, and then for some reason the April, the October, and the December ones are still left over, great. Then you know the distinct cost of those distinct units. In reality, we're probably going to bunch them all together and you're not going to be able to tell one from the other. So we're going to use estimation methods. But if you specifically know which units are still left over, you just take the cost from each of those units and add them together, and that tells you, okay, the inventory that we still have in stock at the end of the year cost us $524. So if we want to find the cost of the goods sold, meaning what was the total cost for the inventory that we actually sold for revenue, you just take the total cost of all the goods that you purchased and subtract that from the cost of the ending inventory, and that tells you that the cost of goods sold was $676, which tells you which will help you determine what your gross profit is. Because if you happen to sell all 72 units that you sold for $7 a piece, well, that would mean that you would make $504, which would mean you lose money. If you happen to sell them all for $10 a piece, well, then you sell $720 minus $676, your gross profit is $26. So that's why it's important to know your numbers, know your costs, know your inventory, because now you know how frequently you're selling, which helps you determine how frequently you buy or produce. And then it also helps you determine whether you're making money or not. So in the absence of specifically knowing which units you sold and which ones you didn't, if they're all bunched together and you can't tell for sure, we have estimation methods, which are the ones that are going to mainly be on your homework and quiz. Weighted average, FIFO, which is first in, first out, and LIFO, which is last in, first out. So the three-step process for the weighted average method is the first two are going to be the same, but the methodology is slightly different. Or actually, that's not true. For this one, what we're going to do is instead of determining, okay, which units we sold and which ones we didn't, we just average out the average cost of each unit that we purchased throughout the year. So you bought some at 8, you bought some at 9, you bought some at 13. Instead of determining, okay, well, these ones cost us 13 and these ones cost us 11, we can just take an average of the total units and the total cost, and then use that, basically just multiply that times the number of units you have at the end of the year, and that gives you your cost of inventory. Subtract that from the cost of goods sold, or from the total cost, and you have your cost of goods sold. So this is the exact same data as before. So if you're trying to look for differentiation in the table, this is the same case study. So 40, 20, 20, 20, we sold 100, or so we purchased and had available to sale 120 units throughout the year. The total cost of that 120 units was $1,200. So we had 8 and 40, 9 and 20, 10 and 20, 12 and 20, 13 and 20. So some sold for more than $10, some sold for less than $10. But instead of trying to parse and figure out, okay, which ones did we sell and which ones we didn't, we just take the average. And so we take the total cost of the units that we made available for sale, and then divide that by the total number of units, taking an average. So if you do $1,200, divide that by the 120 units, that means that the average unit costs $10. So if we want to determine the total cost of the inventory that still exists, then we just multiply the inventory that's left over at the end of the year, which is 48 units, and multiply that times $10. That gives us $480. We subtract that from the $1,200. That was the total cost of the units that we made available for sale. And it turns out that our cost of goods sold is $720. So if we happen to sell them for $10 and using this method, we would say we were breaking even. We would basically have a gross margin of 0. If we sold them for 12, then we'd have a gross margin of 20%. So we're not really focusing on the revenue side, we're focusing on the cost side for this model and for this graph, for this table and for this chapter. But that's kind of the reason why you need to know it, so you can make those comparisons. you didn't notice, my background here is, if I move my head out of the way, happens to be Michigan in a cloud. So you got the Upper Peninsula above me, and you got the Lower Peninsula on the next to me. So I thought that was neat. I didn't find it. I didn't take the picture. It's dark outside, just like it is over there here. But trying to bring some sun, some vitamin D, and some cool backgrounds. So that's the weighted average method. The second method is going to be the first in, first out method. So what that first in, first out method means is that when you're accounting for inventory, it means that you, even if you didn't, you automatically assume that the oldest unit in inventory is the one that sold first. So instead of taking an average, what you can do is say, okay, well, we presumably sell the ones that are the oldest first, and then we sell the ones that are the newest last. And so that means if you have 48 units left over at the end of the year, the value of those 48 units in terms of their cost is going to be attributed to the ones that are bought last. So when first in, first out method means that the units that are bought last count towards the inventory cost. The ones that are bought first are assumed to be sold and counted last, or not at all. So that's the difference. This is like the simple identification method, but instead of knowing which units there are, we just assume the oldest units are sold, so we assume the newest units are the ones that are still available. So we calculate the cost of those ones to determine the cost of the inventory. LIFO will be the opposite. So again, same table, same analysis. We have 120 units. At the end of the year, we have 48 units. So what that means is when we're doing the first in, first out method, we sold 72. So we assume that the 72 that we sell come immediately first from the oldest. So these 40, we assume were sold. These 20, we assume were sold. Well, 72 minus 60 is 12. We have 20 here. So we assume 12 of them are sold, and then there are 8 left over. And then those remaining units are the ones in which we attribute the cost of the inventory to. So since we have 8 left over from May that were $10, we say that that was $80. These 20 times 12 is $240. These 20 times 13, $260. And we add them all up, there's 48 units, 20, 20, and 8. And the cost of the inventory is $580. 260 plus 240 is 500, plus 80 is 580. So if we want to calculate our cost of goods sold, we take the complement of that. So 1,200 minus 580 gives us $620. So that's the first in, first out. Last in, first out is going to be the opposite, where the ending inventory is going to be attributed to what sold first, and then the oldest inventory is the one in which we attribute the cost to. So if we use the 72 units, we're going to go backwards this time. We're going to assume these ones are sold. We have 52 left. These ones are sold. We have 32 left. These ones are sold. We have 12 left. These ones are sold, and then we only have 8 left over after we sell 12 of them. So last in, first out means the newest stuff is sold. The oldest stuff counts as the cost. First in, first out means that the oldest is sold first, so the newest counts towards the cost. So if we do that, we still have the 48 left over. 40 are going to be contributed times 8, so that's $320. The other 8 are going to be contributed to the $9 unit, which is 72. Yeah. So add that together, you get $392. So notice how different it is. This one had $580 as your cost of inventory. This had $392 as your cost of inventory. And so your cost of goods sold here was only $620. This one was $808. So you get variability in your analysis. A similar way to look at this is kind of like with stocks. You could buy 5 units at $10. You could buy 5 shares at $10, 5 shares at $20, and 5 shares at $30. You sell it at, I don't know, 25. Okay. Well, or you sell, let's say you sell half of your shares at 25, not all of them. So well, I guess you have to have an even number. So let's say you sell 7 of your 15 at $25. Well, that's going to be important because if you use last in first out, that probably means that the ones that cost the most, you're attributing as what's being recouped from that revenue from selling that stock, which should probably mean that you're losing money. But if you use first in first out, maybe you're making money off of those stocks because they're the older ones. And you're sitting and waiting and holding onto those remaining stocks that cost more money because of the fact that maybe they'll appreciate and you'll get your money back. So that's the reason why we have these different ways of looking at things. FIFO kind of makes sense because naturally you probably sell the oldest things first, but LIFO may also make sense because it kind of, assuming that the units you bought at the end of the month or the end of the year are more expensive, it might be better to determine, okay, am I profitable even with this higher cost? If I am, then it's even better if I use the other method. Or you can just take an average. So those are the methodologies in terms of determining the cost of goods sold and the cost of the ending inventory. You basically keep track of all of the times in which you make purchases, how much they cost you, add up all those costs together. That gives you the total cost. Subtract that from the remaining inventory's cost using the method of choice, and that'll tell you how much the cost of the goods you actually sold were. So then you can compare that to your selling price, which we don't have here because it's not part of the analysis, and make a conclusion as to whether you're making good money or not, whether you should be in business or not. So here's a summary. This is the same analysis where we had $1,200 was the total cost of goods. We had inventory at the end of the year that was equivalent to $48. Or sorry, not $40, 48 units. So we did the weighted average here. We got $480, or excuse me, $10 per unit. Total cost is $480. So your cost of goods sold is the complement, which is $720. For the FIFO method, you attribute the old sales as being sold, and so the remaining inventory at the end of the year is the one that the cost is attributed to. So in this case, we had $580 left over, which means the cost of goods sold was the complement of that, which is $1,200 minus $580, which is $620. And then LIFO sells the oldest units last and the newest units first. And so your cost of goods sold is going to be, your cost of your ending inventory is going to be lower because you presumably paid less for the older units. And then taking the complement of that determines, okay, it was more expensive to sell those first units first. So does anybody have any questions about this? Okay. So that kind of takes care of the first half, which is the bulk of where your points and your homework and your quiz is coming from. But there are different ways of looking at inventory. We'll start with the retail method. The retail method is kind of bizarre to me because the cost of goods available for sale at retail is really kind of like what your selling price is, which you determine. So in a way, like you already know what the value of the inventory is, you know what the retail is, so it's kind of redundant to calculate a ratio, but this is in the book, so I'll share it. So the first thing that you have to do is you need to calculate the costs of goods available for sale at cost and retail. So the cost way is the same as always. The retail way is based on how much you plan on selling it for. Then you calculate a ratio to say, okay, this is how much it cost me versus how much I'm selling it for, which is essentially the complement of whatever your gross margin is. So if you're selling, so if the cost is 60% of the retail price, well, then that means your margin is your markup is 40%, which is what we learned about a few chapters ago. So then you deduct the net sales from the cost of the available goods to get the ending inventory at retail, and then multiply the cost ratio. So let me just show you in action. So the beginning inventory cost the firm $4,000. They presume that they will sell that inventory for $6,000. During the month, however, they purchased $2,300 additional worth of inventory, to which they believe they will sell that amount for $3,000. So in a way, what you're doing is if the costs are going up, but you sell it for the same price, you're calculating almost like an average markup or an average cost to retail ratio, because different, again, buying at a different time and even if you're selling at the same price, is going to give you different gross margins. So that's part of the reason why they're doing it. So you get an average kind of cost ratio versus just the actual cost ratio, which you would know for any given purchase order. So what we have to do is we have to combine these two together, and we have to combine these two together to determine our cost ratio. So if we take the cost of the inventory plus the cost of the new purchases to be added to inventory, we have $4,000 plus $2,300, which gives us $6,300. If we take the assumed retail selling price of that inventory, assuming we sold it all, and also the selling price of the new purchases of inventory, we get 6,000 plus 3,000, which is 9,000. This is a bit out of order, but the net sales for the month based on data for this company is $4,000, which means that they sell $4,000 worth of merch, and they have $5,000 worth of merch still in inventory. That's the actual believed retail selling price. Now, to determine what the actual value of that inventory is at cost, which is what you should do, because there's no guarantee you'll actually sell it for that retail version. You might end up only selling it for pennies on the dollar if it's not popular, is to take the ratio of these two numbers, which is 6,300 divided by 9,000, which gives you 0.7 or 70% as your cost ratio. So to finally determine what the actual value of your inventory is, you take that cost ratio, multiply that times the ending inventory at retail. And so when you do that, you take 70% times 5,000, and you estimate that your inventory is worth $3,500 at the end of the month. which in a way to me seems kind of strange because you already know how much you paid for it. So you know how much the inventory is worth, and the retail price isn't necessarily consequential. But it is a method. And I can understand why it's useful in terms of determining the cost ratio when you pay different prices for different units over time. The next way to estimate inventory is to use the gross profit method. So first things first is you need to calculate the costs of goods available, which is your beginning inventory as always, plus your net purchases, meaning like the net change between the units that you bought and the units that you sold after you bought. Then what you do is you will multiply the net sales at retail by the complement. Again, complement is 1 minus whatever this is of the gross profit rate. So if it turns out your gross profit margin is 40%, then the complement of that is 0.6. So if this is 0.4, aka 40%, then the complement would be 0.6 or 60%. And then from that, you'll calculate the cost of your estimated ending inventory. So for this example, we know that the gross profit margins for sales is 30%. We have the inventory for the beginning of the year, which is 20,000. We add that to the net purchases, which is 8,000. So we end up with 28,000. And then we take the net sales at retail and multiply that. Essentially, you're creating the cost ratio. I just told you that gross margin was the complement of the cost ratio. This is telling you that cost ratio is the complement of the gross margin. So it's basically the inverse or obverse or whatever you want to call it of what we just did. So we know the cost of goods in total from the difference between our net purchases and our our beginning inventory. So we add those together, like the last slide says, we get 28,000. The next step is to calculate the cost ratio. So if you know gross profit is 30%, then your cost ratio is 70%. So then you will multiply that 12,000 times 0.7. That'll give you $8,400. And then to calculate the estimated ending inventory value, what you do is you just subtract 2,800 minus the 8,400, which is the cost of goods sold. And it turns out that the cost or the value of our inventory at the end of the year or at the end of the month is $19,600. So any questions about that? Okay. We can also determine what's known as inventory turnover. So this basically is telling us how many times the inventory is replaced over a given period of time or a given year. And the way we do that is we take the net sales from the retail, for the retail side, we take the net sales, so how much we've sold of the product, and divide that by the average inventory that's at retail. So if we plan on, if we sold like 170, but the average inventory is 50, well, then it would be 170 divided by 50, and that would tell you that in a given year, you'd probably turn over your inventory about 3.4 times in a year. So basically once every 3.5 months. If you want to do it from cost, then what you'll do is you'll calculate the cost of goods sold and then divide that by the average inventory at cost. And that'll tell you how many times the inventory is turned over that given period of time, whether it's a month, a year, decade, whatever. So to find average inventory, you basically just take the midpoint of the two numbers that you have, the beginning inventory and the ending inventory. So if we want to find the average inventory at retail, we take 11,000 and add 8,900 to it. So that gives you $19,900. You divide that by 2, that gives you 9,950. And 9,950 then becomes the denominator for the at retail. And then your net sales is $32,000. That goes on the numerator. Take 32,000 divided by 9,950. And using the retail method, it determines that our inventory turns over about 3.22 times per year at the Abbey Company. If we do it at cost, well, the cost of the goods sold is $22,000. We started with 7,500, we end with 5,600. We take the average of that, so 7,500 plus 5,600 is 13,100. Divide that by 2, and you get 6,550 as your denominator. Our cost of goods sold is 22,000, so we take 22,000 divided by 6,550, and it turns out that using the at cost method implies that we turn over our inventory 3.36 times per year. So why is that happening more frequently? Well, the analysis is because people steal stuff, so you lose inventory there. You break stuff, you lose inventory there. You liquidate, you lose inventory faster because you're trying to get rid of it. So the inventory turnover is telling you how many times in a given period of time, usually a year, is your inventory reset. So if you have 50, you end with 50, but you're producing a certain amount and you're selling a certain amount, you can estimate, well, how frequently is my inventory turning over? That might be an important tool when you're trying to determine how much you should make in a given period, because of the fact that you have already this existing inventory and it's not selling, or it is selling fast. We can then talk about overhead costs. So we talked about overhead, I think, in a few chapters ago when we were trying to determine what the number of units you had to sell to be profitable or break even. I think that was chapter 8 or something like that. Might have been, I think it was chapter 8 or chapter 9. So overhead is just basically your costs that are not related to the specific raw materials of production. So like a building or electric bills or whatever, that's the overhead. So like there's specific marginal cost or variable cost that is dependent specifically on making that unit, like raw materials and stuff. But you have labor costs and insurance costs and legal costs and rents and mortgages that have to be also incorporated into that cost of production to make sure that you're still profitable or making money or solvent. So if you're in the retail industry, you may be interested in determining how is your overhead distributed based on how much space you have. So this is something that I've seen a couple of times on some CNBC shows. So if you've ever watched the show The Profit, they will talk about how, not in terms of the manufacturing space, but in terms of the retail space, what proportion of our costs or what proportion of our revenues or what proportion of our gross margins can be contributed to this space. We want to make it worthwhile. We want to make sure that those margins are high. So if it's your staple that you sell a lot of, you're probably okay with a little bit of lower margins. But if it's something that's kind of like an impulse buy, you want to have high margins of that because you're paying for it to take up space. And it's not something that may sell quickly. So in order for us to calculate our overhead and how it's distributed based on our floor space, First off, we need to calculate how much space you have in total. Then we take the proportion of each department. So if like jewelry takes up 10%, then or takes up 200 out of 2,000, then that would be 10%. And if electronics take up 40% of 2,000 square feet, or what would that be? 800 square feet out of 2,000 square feet, then it would be 40%. If a freezer takes up 300 out of the 2,000 square feet, then that would be 15%. And then to do that, then you multiply the total overhead costs, like the electric bill and the usage and the insurance and stuff, and multiply that by each department to determine kind of how the overhead is distributed in terms of dollars. So in this example, there are 3 departments: Department A, Department B, Department C. Department A is clearly the largest with 60,000 or 6,000 square feet. Department B is the second largest with 3,000 square feet. And Department C is the third largest with 1,000 square feet. So if we add that all together, we know our total floor space is going to be 10,000 square feet. To determine the ratio, we just take each department's specific square footage and then divide that by the total space. So Department A takes up 6,000 square feet over 10,000. So that means 60% of the overhead can be contributed to Department A. 30% can be contributed to Department B, and 10% can be contributed to Department C. If we have a total overhead cost within this business of $90,000, we can multiply that $90,000 by each ratio, and we can identify that Department A is kind of responsible for 54,000 of the overhead. Department B is responsible for 27,000 of the overhead, and Department C is liable for 9,000% of the overhead. Add them all together to make sure our work is correct. 54 plus 27 is 81, plus 9 gives us 90,000, which is the same as that. So this is a simple example because you only have 10,000 square feet, and then it makes it easier to do the division. But you could have like 1,791 square feet, and you have to decide, okay, well, this is 805, so what's the ratio? Multiply that times the overall overhead. The reason why that's important is because these departments, just because Department A takes up 60% of the space does not necessarily mean it generates 60% of the revenue. So if it's not generating 60% of the revenue, it probably needs to have higher gross margins than the other spaces because of the fact that it has a lot of overhead relative to the amount of sales. Now, on the flip side, as I just mentioned, you can calculate the distribution of overhead by sales. It's a different methodology. So in this case, we're looking at just based on space. So if you are taking up 60% of space, you probably want to sell 60%, but if you're not, you need higher gross margins. Here we can attribute the overhead evenly and say, well, they take up 70%, or they generate 70% of the sales. So we'll contribute 70% of the overhead to that. So that way it's balanced evenly based on the proportion of sales, not the proportion of space. So in this case, instead of calculating the space, we're calculating the sales in the department. So in Morse Company, there's 2 departments. Department A has made $80,000 in sales. Department B has $20,000 worth of sales. So if we add that together, we know the total number of sales is 100,000. So to determine the ratio, well, 80,000 over 100,000 is 80% or 0.8. 20,000 over 100,000 is 20% or 0.2. So if we multiply that 0.8 times the total overhead expenses, which we have identified as 60,000, That means department A is responsible for 80% of that, which is 48,000. So this is A. And then for B, it's going to be 60,000 times 0.2, which gives us 12,000. And then this matches up when we add them together. Then it matches up with that. So it depends. I've seen it applied in both ways. Typically, if you're taking up more space, you need to have a higher bulk of the revenue, or you need to have a higher profit margin if you don't have the bulk of the revenue relative to the other items. So that's why it's useful, because if you're going to create a budget that is attributed to different departments, it may be important to attribute that overhead to those ones that are getting the most sales to help balance out and even the balance sheets throughout different departments within the store. So let's do an example. So again, we only really had 1, 2, 3 things that we aren't covering. The rest of it is stuff that we will cover. That's on the quiz and the homework. So let's do a couple examples like always. So this, I don't have you doing 21. So if you look at the homework for chapter 18, it looks like a lot because it's like, oh, I assigned you 15 problems and then 2 more and then 2 more. Well, the 15 problems, 18.1 through 18.15 are really just 3 problems. And like each question is like 1 line or 1 row from a table or something like that. So it's not as bad as it looks. And then I think there's 1828 and 1830 are assigned. Well, this is 1821. The reason why they're giving us this example, instead of having to fill out an entire table, you're just solving one specific problem. So question 1821 says, if Exxon uses FIFO for its inventory valuation, calculate the cost of ending inventory and the cost of goods sold if ending inventory is 110 barrels of crude oil. So first step is to determine what is the total cost and what is the amount of barrels that were in inventory to begin with that could have been sold. Well, we just got to add those 2 columns. The barrels column tells us there were 365 barrels purchased. And then the total cost column says the cost of those barrels is $35,195. Now, these barrel costs, if this was a year ago, were very high. But now, because gas prices are higher, are actually kind of accurate relative to what's going on in the actual economy. So the first thing it asked us to determine was the cost of ending inventory. So to determine the cost of ending inventory, we have to figure out which method we're using. This says we're using first in, first out. So if we're using first in, first out, and we have 110 barrels left over, that means that we are going to take the 260 or 255 barrels that we've sold and cross them off from the top down. So the first 125 are gone. That leaves us with 130. These next 50 are gone. That leaves us with 80. Oh, it's 265. I'm sorry. So 265 minus 125 is 140. Minus 50 gives us 90. Minus 65 gives us 25. Or yeah, 25. And then that last 25 comes out, or is it 15? Goodness gracious, I'm so bad at math today. So 365 minus 110 gives us 255. Minus 125 gives us 130. Minus 50 gives us 80. Minus 65 gives us 15. Okay. So that means 15 are coming out of this one. So that leaves us with 60. And so the cost of the ending inventory is going to be the sum of 60 times 90, which is what we have listed first here, and 50 and 103. So 50 times 103 is 5150. 60 times 90 is 5400, not 6750 because 15 of them were sold. So we add that together, we get 10,550 is our ending inventory cost. If we want to do cost of goods sold, then we subtract that 10,550 from our initial value, which was 35,195. So 35,195 minus 10,550 leaves us with $24,645 as our cost of goods sold. If it was the LIFO method, last in first out, it would be the opposite. Weighted average, you would just take the 35,195 and divide it by 365. So any questions as to how to solve this problem? Are we comfortable with this? Okay. Question 22 says, Marvin Company has a beginning inventory of 12 sets of paint at a cost of $1.50. During the year, the store purchased 4 sets at $1.60, 6 sets at $2.20, 6 sets at $2.50, and 10 cents at $3. By the end of the year, 25 sets were sold. So the question then is, first calculate the number of paint sets in inventory, and then calculate the cost of ending inventory under LIFO, FIFO, and the weighted average methods. Round to the nearest cent. So the first step is to calculate the number of paint sets in ending inventory. So the first thing we need to determine is how many sets were actually purchased throughout the year. So we initially had 12, which is listed here. Then we bought 4. Then we bought 6. Then we bought 6, and then we bought 10. So if we add all those together, 12 plus 4 plus 4, excuse me, 12 plus 4 is 16. Plus 6 is 22, plus 6 is 28, plus 10 is 38. That is not the number of sets, paint sets in ending inventory. That's just the number of units that we had available to sell. 25 sets were sold, so 38 minus 25 tells us the answer to A is 13. There were 13 paint sets in ending inventory. The total cost of that inventory is the sum of all of this. So 10 times 3 is $30. 6 times 250 is 15. 6 times 220 is 1320. 4 times $1.60 is $6.40, and 12 times $1.50 is $18. So that leaves us with $82.60 is our total cost. So now what we want to do is we want to find the cost of ending inventory using the weighted average method, LIFO, and FIFO. If we're doing LIFO, that means last in, first out. That means that the 25 are going to come from the back end. So we would do 10, subtract 10, subtract 6, subtract 6, and then subtract 3. And so the remaining 13 sets and their cost would be 18 plus $1.60, which is $19.60. So that's using LIFO. If we're using FIFO, then they're going to come from the end of the year, and the ones at the beginning of the year are going to sell first. So minus 12 is 13, minus 4 is 9, minus 6 is 3, minus 3 is 3. So we have 3 times 250, which is 750, plus the 30. So we have 3750 as our FIFO end of the year balance for the cost of inventory. If we do the weighted average, we just take the sum of the total cost divided by the total number of units. So 8260 divided by 38. So 8260 divided by 38 gives us an average cost of $2.17. And then we multiply that times the 13 that are left over. And we end up with $28.25 using the weighted average method. So we can confirm that with the next one. So we have 1960 using the LIFO method as I demonstrated before. 13 units left over, and then you go off of the ones that are still left at from the beginning. The next step was FIFO. We got 28. Did I do this wrong? No, we did it right. It's up here, 37.50. Weighted average is 28.21, which is, I guess I was off by a few cents. Maybe I rounded up a bit, but still close enough. 217 times 13. I don't know how I got a different answer. Maybe I just read it wrong on my calculator. I did. It's 28.25. Whoops. So we got the same answers as our solution. So the reason why these are more expensive is it's because of the ones that are at the end of the year that tended to be more expensive because the cost went up throughout the year. And then weighted average is just taking the sum of the total costs and dividing it by the number of units. So any questions about how to solve that? Okay. So we have 3 more problems and then we will be good to go. So if Comcast is upgrading cable boxes and has 500 obsolete boxes in ending inventory, what is the cost of ending inventory using FIFO, LIFO, and the weighted average method? So what that means is that at the end of the year, they will have 500 left over. Whoops. The question then becomes for FIFO, LIFO, and weighted average, what is the cost per that 500? For weighted average is the easiest, so we'll do that one first. The total cost of all these boxes is $453,000. We had $27,000 to begin with. So if we take $453,000 divided by $27,000, that'll tell us the average box for Comcast costs $16.78. We multiply that times the 500 that we have in ending inventory, and that means that the cost of the ending inventory is $8,390. It's just 500 times 1678. If we want to calculate the cost of the inventory using FIFO, then that means we're doing first in, first out, and we only have 500 units remaining at the end, which means that we're going to get rid of this, this, and then half of this, and you're left with 500 left over. And the cost of those boxes were all $32, so you just do $500 times 32, which is $16,000. If we do LIFO, we go backwards, and we get rid of this, and all but 500 of this. $500 times $15 is going to give you $7,500 for LIFO. So again, your value for the cost of your ending inventory can vary greatly based on the way in which you do the analysis. Questions about that? $18.25 says May's Dress Shop inventory on January 1st was $39,000. And so I'm trying to make sure. I think I might have given you this problem. No, I gave you a different dress shop problem. Just making sure. So May's Dress Shop's inventory at cost on January 1st was $39,000. Its retail value was $59,000. So that's saying that if they sold all of the inventory at the price they anticipated they'd sell at, they would sell it at 59 grand. During the year, they purchased an additional merchandise at a cost of $195,000. So if you add the $195,000 of purchases to the existing inventory, that means that the total cost of the inventory that was available for sale is $234,000. If you add up the beginning inventory at retail and the total number of or the retail value of the purchases that they made, you would add 59,000 plus 395,000, and you would get $454,000. The store actually sold $348,000 worth of revenue. So you subtract that from the estimated sales in terms of retail cost, and you're left over with $106,000. In order to calculate your ending inventory, you have to calculate the cost ratio. The cost ratio is the difference between the cost of the goods and the presumed retail value of them. So that would be 234,000 divided by $454,000. That gives us around 0.52. So in order to calculate our ending inventory, we take the 0.52 or the 52% and multiply it times the ending inventory retail value. And that tells us how much the cost of the ending inventory is. It's 52% of the 106,000, which turns out to be $55,120. So any questions about that one? That one's a little tricky. I think you have one of these on the homework, but not on the quiz. Yes. You have one of these on the quiz. I think it's, or not the quiz, the homework, which I think it's the summary chapter test 4. So really, most of this information is given to you. You just add these together, you add this together, you take the ratio of it, and then you multiply that times whatever this number is minus how much they actually sold in revenue. And then that makes the estimate of how much the cost of the inventory that you have is. Because basically the average gross margin is 48%, so your average cost ratio is 52%, which is why you can feel comfortable saying that's how much the inventory is worth. And then the last problem is basically doing the complement of what we just did in terms of doing the gross profit rate analysis. So if we know the gross profit rate is 35%, remember the cost ratio is the complement of gross margin. So it's going to be 1 minus 0.35, which is 0.65. So that's our cost ratio. That's right here. If we know that our inventory at the beginning of the year was $6,000 and the net purchases throughout the year was $64,000, we know that the total cost is going to just be the sum of those, which is 6,000 plus 64,000, which is $70,000. And then if we take the net sales at retail, which is $49,000, and multiply that times the cost ratio, so 49,000 times 0.65, gives us the estimated cost of goods sold at $31,850. We then take the cost of goods sold, so we take the net cost of goods available and subtract the cost of goods sold from it. So we do 64,000 minus 31,850. And that tells us the estimated inventory that was lost in the fire, because all the inventory was destroyed for Ginny, is $38,150. So this is how much the inventory was worth that was destroyed in the fire. So essentially, this is what they presumably might get from insurance. So does anybody have any questions about any of these example problems or the concept?